Hello and welcome to your macro outlook. It is Thursday, April 3rd, 2025. I'm Patrick Ceresna. Let's jump straight to the charts. The S&P 500 down 200 points. The tariffs obviously were pretty wide sweeping and the market is reacting negatively to it. We are at the March lows, which was about a month ago, but the floodgate really is open. So the big question is, will we see the full spill? At this moment, it feels like it. We see clearly credit spreads widening, volatility jumping, all the assets selling, which is very typical during the stages of a liquidity event. So there's a lot of reasons to anticipate that there's more selling to come. So what are we still expecting? Well, let's go through the same analog we've been working on for a while, which is 5,200 is the measured move on the downside here. And we're looking for an extended move down towards even 5,000 if this gets really in an accelerated state. The one thing I will highlight is that if in fact this scenario does play out and we really do have that spill, then odds are very reasonable that it's going to happen very quickly, as in like Friday or Monday or Tuesday, like 3-4 days of selling, we could be down there, because when it happens, it all happens all at once. And you have to think that this can, you have to already have the game plan for how you're going to conduct yourself in reaction to almost all of these different moves. So what is a further thing that's driving this? Well, first of all, recession risks have risen. We were almost at 50%. We were at 50% yesterday, and now it's around 47% chance of a U.S. recession based on the betting markets. And this is real money being put out there. So we're now getting to a 50-50 chance of a recession, making Friday's jobs numbers just huge. Why is this? Well, a Goldman report came out, and I want to specifically highlight just one thing, which is the earnings per share scenarios. What I want to highlight is I've made it very clear that in order for there to be a bear market, you need earnings contractions. Corporate earnings have to be dropping. And so what you can see here is a fantastic model they put, and we talk about this in our Macro Masters program, and they just did a great job here just explaining it this way. So you can see all the way on the right is the bottom-up consensus, which is the consensus is that corporate earnings growth will be to $269 for every for the S&P 500, and then you have the Goldman Sachs baseline, which is 253%, which is only about a 3% growth versus a 9% growth, and then the recession scenario, which has a 11% contraction in corporate earnings. And by the way, 11% contraction we've seen 30-40% contractions in corporate earnings in previous down cycles. So if the recession scenario is going to happen, then you can observe these downside targets. So let's go through it. First of all, maintaining a PE ratio of 22, saying that all of these concerns means that the multiples still stay as rich as they are. Under a recession scenario, has an S&P 500 downside target of 4,850. But here's the key. During sell cycles, when there's a lack of clarity about corporate earnings, the multiples are usually drawn down. In other words, people are not willing to pay the same multiple for the same earnings. You can see they put the 5-year average, the 10-year average multiple, the 30-year average multiple, and more importantly, the 2018 low, which was the Christmas massacre low. And what you can observe is that if we came into that recession, which is now a 50% chance, we could, and we had multiples just come back to levels where they were trading, for instance, during the Christmas massacre. That's a 44% drop in the stock market to 3,100. Now, let's again, this is not a prediction of what I think is going to happen. It's about the risk. You want to size up the real possibility of that if this does become a recession, what kind of a downside move can have. And so what you can observe is like just on a weekly chart, that 3100 would that would basically be just sending the markets right back down to 2022 bear market lows if this thing's got really ugly. So there's and or even COVID high levels around 3100 would all be plausible under that Goldman scenario if there was a recession and a corporate and a multiple contraction. And so strap on your seatbelts. It's going to get interesting. Okay, so let's just talk about the rest of the markets here briefly. So by the way, just again, the most immediate downside targets down towards that 5,200 to 5,000 level. Okay, so the Nasdaq, by the way, broke into a lower low. The selling continues. The Mag sevens are already going to be opening around 44.75, which is pretty much along their lows. The Russell down 5%, broke into a lower low. The selling just is persisting, and we have volatility index, the VIX, spiking, but not a melt up yet. And so I would envision that this VIX is going to get very aggressive, maybe up to 30 to 35, 40 on the upside, almost like what we saw during the yen carry trade unwind, where that kind of a melt up in the VIX can happen. That will mark something very close to what we would be looking for when we're going to speculate about a swing low in the markets. Okay, so let's just touch here on junk bonds, because I want to highlight, we were talking about them being the canary in the coal mine. They continue to break down. I don't have a pre-market here, but I'm sure it's going to be lower. And as recession risks rise and junk bond credit spreads widen, junk bonds break down. That is the environment where the stock market is going to struggle. So this is not going away. So let's talk about the dollar now. A nasty 2-point drop on the dollar indexes, as we've now dropped to about this 101 level. And so this type of aggressive selling is open the window to retesting of the lows of last year. Now, will it turn into something more ominous than that? Let's take it one step at a time. Like right now, these measured moves on the dollar are down there to those lows, and we'll see whether or not the currency stabilizes there in the bigger picture. Just touching on crypto, Bitcoin not reacting hugely, but you can see a big reversal yesterday after testing the 50-day. It still looks like a flagging formation for a continuation pattern to the downside. You can't be touching Bitcoin at this stage. On the commodity front, gold down $50, bearish engulfing candle. But guess what? Gold hit a high of 3,200. What was our target? 3,200. Bearish engulfing candle. It's entirely possible that we're going to go into some corrective mode here in gold. Now, as this measured move finished, there's likely going to be at least a shallow one down to 3,000. Or if it's a bigger correction, it could go to 2,900. It's going to be a buy on dip. It's going to be a primary bull phase, but on the short term, anticipate that gold can very much weaken. Crude oil taking a very bad spill down $4. With this kind of a flagging formation, with this type of a pop, you have to recognize the most immediate downside risk that crude oil can still actually make a spill down towards $60. Now, we talked about the trade range prevailing, but with this type of a breakdown, more importantly, when all assets are selling at a time when recession risks are rising, this nervousness is what drives the drives the market to potentially distribute. And so do not rule out, don't rest comfortably on an idea that low will hold. There's a real chance here that this thing could spill on the downside. Silver, by the way, as well, down $2. Again, right now, think of almost like the selling that happened during COVID. When the risk-off impulse happens, it almost certainly drives a feedback mechanism that creates a downdraft in almost all risk assets. Nothing really is safe in that environment. You have to accept this kind of volatility to be true. The just touching on a couple other things, like copper continues to correct. I still think natural gas can march the beat of its own drum, but again, this market it's a very sketchy spot right now, and you have to be very careful in this window of time. I want to talk on these bonds. So look at the way that the SOFR futures are advanced. So a rise in the 2025 to 2026. Look at this jump. Like right now, that 2026 December contract ripping higher as it's becoming clear that we're going to have lower interest rates going into next year, and this thing is definitely rising. And more importantly, bonds behaving in safe haven. They're all ripped higher between yesterday to today. So we have treasury bonds all acting in their safe haven thing. It's amazing. The dollar isn't safe. Nothing's safe but bonds. Bonds have been the place to hide in this last little bit. And so we'll watch how whether that continues to develop. Quickly, Nikkei taking a pretty heavy spill on the downside. Euro stock taking a heavy spill. Oh, everything's down 3% right across the board. And so right now, global equities all correlating. We could try to play this European theme on as its own standalone, but right now, everything is selling in reaction to this, and you have to expect that anything that's a risk asset is vulnerable at this time. We'll continue the conversation during Where's the